Hi, good morning. So, Manoj and I welcome you to the conference call for the month of June. You may wish to turn off your videos if you're not speaking. I think we are ready to start. Welcome. There's a lot of developments that have happened over the last few days, weeks, and months as well. And we've been at work in terms of analyzing the impact of this on our portfolio, on the investment prospects, etc. So we'll do a fairly detailed walkthrough. As usual, we will cover first the environment. What environment are we currently in, both the macroeconomy as well as the geopolitical um, implications that we are seeing of various events. And then we'll go through various sectors. And while I cover the sectors, we'll also touch upon the stocks that we have in our portfolio, some we've recently added, etc. So over to Manoj.
Yeah, good morning, everyone. Before I get started, Ram, you want the slides to be put up? Will you be controlling because you are the host now?
Yes, I will put the slides as well. You can start extempore. You don't need any slides to.
I don't need any slides, but okay, chal.
Yeah.
Okay, so good morning once again. As always, we will do a quick global macro roundup and then talk about India. Over the last few months, particularly after it became clear that Trump would be the next president of the US, we have not had a great economic period. Growth forecasts have been cut down. There is too much uncertainty owing to Trump tariff tantrums and turnarounds, as well as geopolitical situations leading to trade tensions and financial volatility. Global GDP growth rate for 2025 was projected at 2.3% by World Bank. Morgan Stanley pegs it at 2.9%, while IMF numbers for 2025 are at 3.2%. Slightly better, but still on the lower side. Growth forecasts have been cut for nearly 70% of the economies. 2026 numbers are also not very encouraging by any standards, with most projections in the 2.3 to 3.3% range. Now, surprisingly, World Bank has increased that percentage to 2.5 vis-a-vis 2025, while IMF has cut it to 3.1%. Nevertheless, they all fall in that range of 2.3 to 3.3. Now, while these are the growth rates for various economies, let us now just take a look at the geopolitical tensions which are on the rise. We have Russia, Ukraine, we have Israel, Palestine, we had India, Pakistan, and now most recently we have Israel, Iran. Every day we are waking up to more and more conflict related news. Israel has declared that they will take any number of days to achieve their objective, and Iran has threatened retaliation. So both the countries have indicated that they intend to continue with the escalation. Oil prices have spiked more than 10% in a day. They've crossed the $70 mark. And with all the measures that come with war, closure of skies, diversion of trade routes, which will mean more delay in supplies, increased uncertainty, more risks, and therefore higher costs of transportation, of insurance, etc. There is a projection that oil after a very long time can once again see triple figure dollar mark. Neither country can afford resources for a prolonged conflict, but we will see a long period of intermittent attacks. and a lot of virus on show. Not a happy environment for trade, business, and markets. Russia-Ukraine refuses to abate. Again, here also, neither party can afford war, but neither party is willing to grant any concessions. Despite diplomatic efforts, hostilities are intense. Any temporary ceasefire, like our Trump had suggested, will be uneasy. German support to Ukraine is very critical here, and Germany is again paying for it, for the support it is extending to Ukraine. Now, what is important is that we see a change in approach of governments. They seem to be more willing to take the military route, even if the words used are restrained, targeted, non-escalatory, etc. But safety and survival of self, coupled with the thought that the opposition can be insensitive or stupid, is driving more activism. Now, each of these incidents, neither Russia-Ukraine happened yesterday nor Israel-Palestine. It's only Iran-Israel happened yesterday. But each of these incidents, they can be considered as relatively low impact on global and Indian economy, but cumulatively and continuous conflict mode can lead to a considerable impact. Hopefully not of catastrophic proportions. Now, again, this backdrop, let us quickly look at the region-specific situations. We will start with the US economy. Now, the US is fast losing credibility on a daily basis and is providing a master class on immaturity. Over the next 4 years, we will see many nations create alternatives to reduce dependence on the US. The largest economy is not a market one would want to forego, but there will be no one willing to surrender to whims and seemingly impulsive actions. Numbers look bad for the US. GDP growth at 1.7%, down from 2.8% in 2024, and projected to slow down further in 2026. Inflation was looking under control. The expectation was of a rate cut cycle. But suddenly, with all this tariff-related uncertainties, this has led to a speculation of increased conflict and therefore higher inflation, higher interest rates fueled by higher inflation. Now, what saves the US economy is the near invincibility of the US dollar. Now, for example, the Iran-Israel conflict has led to further strengthening of the US dollar. That means US dollar has more purchasing power. Now it can buy more with the same amount of money. And therefore, it has in a way greater ability to tame inflation. Whatever price rise we are seeing on the inflation front can be adjusted because you can buy more with the same money. So the US is likely to trudge along, leading by luck rather than design and by virtue of being in the position it is currently in. As much as we rule out a recession, we also don't expect high growth rates happening in the US. It will continue to be plagued by policy uncertainty. And that is not a happy place where you can bet your money on. That takes us to the next largest economy, which is China. Now, almost everyone seems to hate China. But no one can possibly imagine life without China. While we talk about low consumption, low wage costs, dictatorship, etc., China's latest decision to curb supply of rare earth magnets can have a major impact on world economy. With almost all new age ideas and industries, you call it clean air, digital finance, new age defense, automobiles, all of these are dependent on Chinese large-heartedness because they have a firm grip on these rare earth magnets. And they have recently threatened that they will cut the supplies. Insofar as economy is concerned, it's shown a very decent growth rate of 5.4%, predicted to slow down further, maybe around 4%, definitely much lower than its earlier double-digit growth rates. And Indians in particular feel very happy that we are beating China to become fastest growing large economy. Now, this is some record which we have been claiming for many years now. But there's a difference. China's economy is close to $20 trillion, about 5 times the size of Indian economy. So, in absolute terms, there is much more economic activity happening there than what is happening in India, and the gap is actually increasing. Now, China has its own challenges. It faces demographic stagnation. There are regulatory headwinds. It is not seeing the same investment-led growth panning out. Even exports are now a lot more jittery. The conflict with US is not in its interest, and yet China is steadfast in its aim of becoming the largest economy of the world. It aims to overthrow the US as the #1 economy. Currency confidence is perhaps its weakest link. Today, despite China's size and its influence on the global economy, a nation would prefer to hold its reserves in USD rather than China. So over the next few years, we can expect China to do something revolutionary on the currency front to wrest control of global leadership from the US. Think of something absurd. Let's say China says, okay, I will shift to Bitcoin. Bitcoin will be my currency. I mean, we are not going to speculate on that. I'm just telling you that if China can resolve this issue, then it will have much greater chance of asserting global leadership. Now, without going into all the other areas, Eurozone, Japan, etc., we'll now straight jump into India because we have a lot of ground to cover. Now, look within, and everything seems to be not just fine and reassuring, but actually impressive. Fastest growing economy, driven by consumption and government capex, shifting demographics, digital economy, low inflation, low interest rates, strong FDI inflows, swelling forex reserves. India is the lone bright spot in an otherwise gloomy global arena. Everything seems to be working for the country. However, India's challenges come from external factors. The US is giving no assurance of reliability. If the president of US can publicly tell a corporate leader that if you produce your iPhones in India, I will hike tariffs, that doesn't give us any sense of confidence. The gloomy global economy implies less scope for surge in exports. And this latest development of rising oil prices is definitely bad news. If the conflict escalates and oil sees a triple figure number, it crosses 100 USD, that can have a huge detrimental impact on Indian economy. Now, China seeing India as its competitor and hence supporting destabilizing efforts. While India's dependence on Chinese manufacturing as well as the rare earth magnets continues. These are all concerns that stem from the outside. So it is going to be challenging. Not saying anything new here. All of us probably know what I'm speaking about. However, the global equations are going to be even more dynamic going forward. The positive part is that we as a nation seem to be doing the right things. We are not acting complacent. We are looking at the longer term big picture. We are investing in the right technologies and we are making a mark. Undoubtedly, these augur well for India. We are betting that countries will not disappear overnight. And in such a case, India will continue to shine bright. It has the ability to make the most out of the positive economic environment and the goodwill earned over the last few years to counter challenges and offenses. Given this backdrop, our immediate concern, ये सब छोड़ो भाई, market का क्या होने वाला है? What will markets do? Again, US markets will be volatile. Despite some strong corporate earnings, uncertainty is likely to pull down US indices. China, on the other hand, is heavily undervalued. It's got very low PEs, but it still needs to earn the trust of global finance. People are wary of China and how it will behave. Japanese markets are already scaling new highs. But with almost flat growth rates, we can't expect supernormal returns, particularly after allowing for currency conversions in an era of falling yen. Germany, because of its support to Ukraine, is on the verge of recession, which once again makes India a natural choice for global investors. Favorable macros that we talked about, stable and strong leadership, strong domestic demand, lower inflation and interest rates, these are all likely to result in Indian markets remaining outperformers amid all volatility. Now, when I say outperformers, even in a falling market, if other markets have fallen by X%, India's market is likely to fall by less than X%. If there is one country which an investor can bet on, it is likely to be India. There will be huge movements on either side. Indices will shoot up, indices will drastically fall. But the long-term direction is clearly upward. India is likely to outperform even in the short term, and hence it is best to remain invested into India, and that is the right decision. The final take, global growth remains weak, policy uncertainties and trade tensions are persistent drags. US, Europe, Japan are likely to see choppy markets with limited upside. India is the standout, both economically and in equity performance. China is the X factor. With this, Ram, I will stop. I think we have lots to cover, so maybe you can take over from.
Yeah, thanks, Manoj. So we will have a lot of room for Q&A, but I think Manoj Kumar has raised his hand.
Hello.
Yes.
Hi, Mr. Ram. A very good morning to you and to Mr. Manoj Trivedi. Manoj is asking a question to Manoj, so that's a beautiful thing. So I looked at your slide and one small thing came to my mind. in spite of the huge push by Modi ji regarding in India for India, and certainly trying to make India as a manufacturing hub, you have shown that dependency with the China. I just wanted to learn a little bit. What is our key dependency of which sector we are highly dependent on China, and is there any plan from government of India to come out of those dependencies?
Okay. So Manoj's question, Manoj has the answer. So probably I will take it.
Thank you.
See, let's go back to 91, 92 periods, and we were in a similar situation. We were forced to open up the economy. We had to allow foreign companies to compete into India. And at that time, many corporate leaders said that there is no level playing field. India's cost of production is very high. India cannot compete with these companies or the imported products, and therefore this can probably wipe out the entire Indian manufacturing space. Now, what actually happened was, one, the government couldn't do anything about it. It was inevitable. We had to open the economy. There was no choice. So the only thing left was for the Indian manufacturing sector to pull up its socks, tighten its belt, and deliver. And that's what we have seen. Particularly, if you look at the automobile sector, etc., today India is far more competitive even compared to China. Okay, we beat China even on price. So it is not that it is going to be forever for us to depend on China and that we cannot produce, etc. But the whole concept of globalization is based on the fact that there will be some countries which will be better at doing certain things, and for the world economy, it is better that those countries continue to do that. Of course, we want diversification, we don't want dependence, etc. So people will always look for backups. Now today, because of its low cost production, China dominates the manufacturing sector. And this is this popular belief that you can't beat China on price, which, as I explained earlier, is not right. China can be beaten on price also. It is a question of enhancing one's efficiencies. But this is going to take time. Today, if you are a businessman and there is a choice of producing something by spending 10 rupees versus buying from China at 8 rupees, as a prudent businessman, as a finance guy looking to increase your profits, you will say, why should I take all the effort, labor problem, this, that? I will simply buy from China and my problem is resolved. Okay. And that is where the Make in India, the PLI scheme, etc. is coming in to incentivize these people to say that, okay, you may not be able to immediately beat China on price, but it will take time for you to develop those competencies and beat. So China's dominance is not just with respect to India, it is with respect to almost everything all over. China is called the world's production factor. But then things are changing. And for many global outsourcers, India is looking to be the best alternative. So this China plus one policy has benefited India. And hopefully, with greater competitiveness, more effectiveness, enhanced efficiencies, we should be able to compete, if not beat China. Does that answer your question, Manoj?
Absolutely, and you have covered it from all different sides. It's a certainly a strategy which carefully we are dealing with, and in-house in-country capabilities also increasing. Plus, also we are looking at the alternate sources. While China still dominates the manufacturing, but I think we are also catching up. And as you rightly said, in the Toyota model, Toyota is not making all the parts, correct? So they in the similar way, we will not be able to do everything by ourselves. We will have in the interconnected world, we will have the dependency. But certainly when the geopolitical situation becomes bad, that time having self-reliance is also very key part. So thank you very much for answering, and you covered it so well. Fantastic. Thank you so much. Thanks.
If I may add, the trade deficit is $100 billion right now with China, and all the points that Manoj Trivedi ji mentioned, they will slowly help us reduce that. There are two leading indicators which can give us comfort. One is Apple has moved a bunch of manufacturing to India, and despite Trump admonishing Tim Cook, he has not backed off, and that thing is continuing. So when you have such a complex technology product being manufactured in India, yeah, agreed, some parts may be imported, but the fact that Apple iPhone is it's got a made in India tag is going to be a boost for the other countries and also internally. Second is what we have seen with our the output of our defense industry, DRDO, BEL, etc. The fact that they've done such great feats in the last 1 month is also proof. Now there are a lot of I'm hearing that into the IITs, people are seeking electrical engineering and other disciplines more than computer science. So I think that is required. And it's somewhat related to the other question that RJ asked, which I will cover later in the call. So our manufacturing, our electrical components, etc., they are going to be very, very important. I'll cover that also in the various sectoral points that I will now come to, and we'll move ahead in the call to the next section, which is the sectoral analysis. And so I will cover one by one sectors and talk about some of the stocks that we are having in those. If there are any questions, kindly reserve them towards the end. We will want to spend a lot of time in Q&A. Again, based on the previous call feedback, we've put a few slides so that we can cover these points a bit more carefully. So in the banking and NBFC space, we have seen strong growth in the net interest income. Interest rates are slowly coming down, so therefore credit is expanding. Margins for these institutions are improving. Asset qualities, as measured by non-performing assets, they are showing a declining trend. And many of these companies are engaging very good loan origination systems and credit rating systems, etc. And the regulatory environment in terms of RBI has come up with a lot of regulations with respect to housing finance, gold finance, etc. So we are seeing a good growth in this. We have sufficient exposure to this sector. If among the larger companies, we have recently added Power Finance Corporation and Shriram Finance, both in this space. Couple of stocks that we've had for a very long time, Chola Finance and Bajaj Finance, have done extremely well. Aditya Birla Capital did languish last year, but now this year it has hit an all-time high. In fact, this month itself. And there is a huge growth in terms of housing finance that is happening in the whole PM Awas Yojana, etc. And we are seeing a lot of this growth is happening in the northern parts of the country. In the south also, you will see good growth, but because digitization of land records and other such reforms happened in the south, 15, 20 years ago, housing finance did really well. But now states like Uttar Pradesh, Rajasthan, etc. are seeing a lot of growth. Aditya Birla Capital that we are holding has deep presence in the tier 2, tier 3 towns of Uttar Pradesh. So that is what we are seeing in this space in the banking and financial sector. And of course, I didn't talk about HDFC Bank, that also we are holding, and that also is doing well. In the pharma, again, prescription growths are outpacing the over-the-counter segment. There is a price erosion in the US generic space. We have exited Natco Pharma. That didn't do well for us. And like Manoj said earlier, the China plus one factor will continue to benefit the pharma space. And the biosimilars is another sector which is growing. There's a good R&D pipeline. So basically, this sector is also reasonably good. Now, what we are doing is on the established blockbuster drugs, there is Abbott India, which we continue to hold. It's a good long-term steady performer. And in the smaller company space, we are holding Marksans Pharma and Caply Point as well. So these companies are also doing pretty well. Marksans, in fact, posted its highest ever revenue and profit in FY25. And not only us, but other institutional holdings are also adding this stock into their respective portfolios. Similarly, Caply Point. So these are a couple of things in this space. Consumption and fast-moving consumer goods. The consumption space also is going to see a lot of growth. There has been rural recovery, and B, the whole urban premiumization is a trend. We are seeing off late that even fast food chains, your Darshanis, as they call it in Bangalore, they are all getting premiumized. So people are spending a lot of money on premium goods and services. They don't mind standing and eating if it is in a high-end premium fast food joint. Margins are expanding and distribution reach is growing. Because of inflation, the input costs are also moderating and prices are stabilizing. So we're seeing some good category leaders in this space. We have added a company called Varun Beverages into our jewel portfolio. This company is doing pretty well. There's a lot of increasing spend on cold drinks, and it's pretty much got a monopoly with Pepsi manufacturing in its bag, etc. for 15 years. And they're also expanding into many African countries. So that is another interesting stock that we've added. In terms of consumer, another thing that is consumer related is consumer durables. So here also we've added a pretty interesting stock, which is present in the manufacturing of white good appliances, PG Electroplast, into the jewel portfolio. So, and we've also added another air conditioning company into the portfolio, which it is riding on this whole growth in the refrigeration and AC business across middle class households and premium. So India being a tropical country, this sector is going to do reasonably well. Of course, in our PMS, we are staggering the entry because there could be a slight price change, but in the advisory, we have given it because we can't make too many interventions in the middle of the quarter in the advisory. So these are a couple of developments in that space. And moving forward, automobile and auto ancillaries is another interesting space, which is seeing a lot of growth. Here again, the premiumization trend, there's a lot of SUVs on the road. With the credit boom likely to pick up, we could see a lot of commercial vehicles also pick up because people depend on CV finance to pick it up. EV is another area where the government is supporting quite a bit. So here, from a jewel perspective, we've had Eicher for quite some time. Eicher Motors is doing well. And they have both not only in the Royal Enfield segment, but also in the commercial segments, they're doing pretty well. And their motorcycles sales crossed about a million in number. The interesting thing is in the emerging company space, we have added we've had three stocks in our Spark portfolio. And these companies are maturing. They have not only delivered well for Indian manufacturers like your Tata Motors and Mahindra and Hyundai India, etc. But they're also becoming strong enough to supply to global markets. So companies like FEIM India, which we recently added, Gabriel and Sharda Motors also we've had for quite some time. So we are pretty bullish on that space, especially the auto and ancillary space. Next, I will talk about real estate. Again, real estate is, if you see the residential demand is there, home ownership is always an evergreen aspiration, and low interest rates are going to drive further sales here. So our view is that companies which are focused on the premium real estate will do well. So Oberoi is in our portfolio, Oberoi Realty is in our portfolio. And I mean, there are other bullet points here which you can read out. The absorption rates are also improving. Next sector is metals and mining. So here again, infrastructure spending is increasing the demand for these. And just pick up. So so we are actually tracking this space a bit closely. We are looking at the impact of copper on various industries, including EV industries. So this sector is again that we are tracking this quite closely. Telecom, I'll just skip some of these sectors. It's going to be, yeah. On the infrastructure side, again, there's a lot of build up in terms of the budget allocation this year slightly dipped, but the fact is that things like roads, railways, urban infrastructure, etc., are going to be quite heavy in that. Defense is another sector where there is a lot of emphasis. We've had in the jewel portfolio, we've had BEL and HAL as a couple of key stocks in this. Both are doing well. Government, in fact, wants to even privatize the manufacture of some of the aircrafts, etc. So there could be companies like the Adanis and Reliance coming into that, L&T also coming into that space. So this is a broad ringside overview of the various sectors, and we have a lot of time for Q&A, so we can start off on that. So the first question is, I didn't cover information technology because this question already came, so I'll request Manoj to cover that. So I think RJ's question, which is missing in the chat, but I'd read it earlier, is that with so much of AI and automation happening, what is the future of the IT industry? Will there be any jobs, etc.? So you can cover that, Manoj, and maybe talk about our view both in terms of Jewel and Spark.
So we were talking specifically about information technology. Okay, our view is that obviously this sector is not going to disappear for all the AI talk that we are having. We will continue to have the need for large labor force, but it will get a bit commoditized, and there will be premium only for the skilled sector. Okay, so the kind of environment that we've seen maybe over the last decade or so, we will not see that kind of growth in the IT sector. There will be competition. Having said that, there are certain companies in the sector which are doing some very different work, working on new technologies, cutting edge, delivering some superior value to their clients, and those companies are likely to benefit much more in the days to come. So we have a couple of stocks. We invested in some. Some of them have given very good returns, and some have failed on their promise, which is quite can't be ruled out. But our focus in IT is to look more at what the companies are delivering to their clients. Currently, the tendency is to stay away from the large companies which are probably doing everything.
So if I were to add a few specifics, the one key stock we have is L&T Mindtree, which we are monitoring, and we might be exiting partially. This company obviously was in the news. They came under threat because, see, in the US, what's happening is after Trump, some companies like Citibank, etc., are trying to do some insourcing. And overall, we are seeing that with AI, a lot of the US companies, which are big on outsourcing, right? They are trying to focus more on AI and machine learning, etc., and other work they are trying to outsource. So that may temporarily result in a good volume for India, but long term, things look dicey. That's the reason why in our Jewel portfolio we are not that heavy on IT. We have only one major stock, whereas earlier we used to have about 3 stocks in Jewel in IT. However, there are niche companies which are building specific IP and products. And those companies need not be large. So we are looking at, for example, Apple in India. I mean, this company does a lot of technology-based automation, AI, etc., for marketing. I mean, it's kind of it's using IT in a big way. And Apple has been in our Spark portfolio for quite some time. Similarly, MPS is another company which we added about 3 quarters ago that provides IT solutions for publishing companies. So they're able to produce ebooks at half the cost of what European companies do. So there are some European companies which are leaders. And when we did a detailed tariff analysis, we found that even post additional tariffs, MPS Limited was still competitive. Similarly, the other more well-known company is Newgen Software, which we've had for a few years now, and they have excellent technologies for process automation, etc., specific solutions for BFSI, government sectors, etc. And this stock we see a long-term future in the stock. Since we added, it has grown manifold. Some corrections later, but we still see a good run for this upwards run for this company. So I hope that covers the AI part. Chaitanya is asking a question, Manoj. Impact of Q-commerce on FMCG and impact of supply constraints of rare earths on electric vehicles in the auto space. Will that result in gas-fueled vehicles experiencing an uptake?
Can you repeat the question for me, Ram? Or maybe I should open that. It's there in the chat.
Yeah, it's a bit cryptically worded, but
no, that's okay.
I think there are 2 questions here. One is quick commerce on FMCG.
Impact of quick commerce on FMCG. See, when we say FMCG, we are essentially talking of these large brands which are having, companies with large brands which have had huge presence. And Q-commerce will probably only help those companies and not compete. Having said that, yes, there will always be pockets. Organizations will try to create their own brands and push those brands against the well-established ones. But in the overall scheme of things, given consumer behavior, our thought would be that the impact would be minimal. Yeah, rare earth supply on EVs is definitely a concern. But again, this these are negotiation tactics. Okay, it's not that China will say, okay, I will not supply rare earth magnets to anybody and supply produce the whole thing. I anyway have 90% control, so I'll take 100% control. End of the day, you need markets. You just don't want to do everything on your own, because there will be people who look for alternatives. Gas fueled vehicles will have their own challenges, and there will be demand for all kinds of products. But if someone is looking at EV, they will want an EV. What will probably happen is the vehicle might become expensive, because China will command its share of pound of flesh, whatever it is called, and therefore, in the negotiation game, maybe the product is still made available, but at a higher cost. In that case, the EV itself might become expensive. People might look, those who are comfortable with a gas fueled vehicle might feel comfortable, but those who have driven gas fueled vehicles, some of the experiences are mixed. So it's a market, and then there is marketing. Both aspects will play out.
Okay, next question again from Manoj Kumar. Our thoughts on green energy, wind, solar, and hydro. It seems like India is investing heavily in green energy.
Look, we've discussed this earlier also. Again, this is one of the long-term thought process of the current government. One of the major factors that would pull down India was its huge dependency on oil, and that continues to be there. And therefore, as a long-term strategy, particularly having rich solar resources, it made sense to tap into this resource and build an alternative to the non-renewable sources of energy. Having said that, again, even for solar and wind, etc., there is a huge dependence on China for various components. So it's not that you switch off or switch on and then things will change. Challenges abound even on the renewable sources of energy. But as I said, some negotiation, some alternative generation will figure out. So it is going to take time, but eventually, I think efforts of India to reduce the dependence on fossil fuels, oil, etc., and enhance its own energy generation through renewable sources, hopefully will pay off for the country.
See, we are tracking this sector also, and one reason why we added Power Finance Corporation is because they have good exposure to many of these companies in their loan books. So that is one way to benefit from this trend. However, some of the other companies that we have seen, they're either very expensive or they've engaged in so much capex that it's a very, the cost of a solar panel now, it's extremely cheap. So investing in a solar manufacturer is tough. And in fact, last week I met with one CEO of a solar and wind manufacturing company in Chennai. And what I hear is that the government schemes in terms of incentives, PLIs, etc., they are not, they seem to be favoring certain geographies. That is his perception. So government also needs to do certain things in that space. However, power generation, distribution, storage, it's a big theme. And as India grows and hopefully doubles its economy over the next 6-7 years, there's going to be a huge rise in this space. If you see the trend of electricity production in the IAP indices also, you'll see that it's a steady growth, and the Nifty indices that track power also have consistently gone up. So that is a theme to definitely play. However, we don't want to jump into some company which is very expensive, or some company which has taken so much loan, or some company which has dependent on so much government policy that any change may adversely impact them. So that is our take on the energy space. Next question is from Sridhar S. Do you see any good opportunities in BFSI sector after the recent RBI's liquidity-inducing measures, as well as the measures on relaxing credit norms for small ticket gold loans, etc.? And how are you positioning the portfolios for that? I think I covered this when I talked about the BFSI sector. There are a lot of opportunities in that space, and definitely we have adequate exposure to the BFSI space. There are at least 4-5 stocks in the Jewel portfolio and another 2 to 3 stocks in the Spark portfolio, which are capturing this trend. We are seeing good growth in net interest incomes. We are seeing good credit expansion, margin improvement. NPAs are healthy, and credit norms of small ticket gold loans that you mentioned, that is going to benefit lending finance companies. So Manappuram, for example, is one beneficiary, and it is in one of our other portfolios. But this was again a new policy announcement. One couldn't expect that as such. Gold loan business, again, given the prices of gold where they are, we are watching. It's not that we are aggressively getting into a gold loan company. See, my understanding, having worked a little bit in the NBFC space, is that every company has a DNA. Okay. Just like in IT, Newgen has a certain DNA and they are making good products. And whereas IT services companies have a good DNA, a certain DNA, they're not good at making products. Similarly, in BFSI space also, certain companies specialize in gold loans. And when they try to cross-sell into other asset-based finance, it's not easy for them because asset-based finance doesn't give the kind of yields and NIMs that gold loan gives. But then gold is a very spiky business, and other asset-based finance companies like a Poonawalla FinCorp, etc. If you see, where I worked there for some time, they tried their hand at the gold loan business, but they couldn't succeed. So after some time, about a decade back, they kind of exited that gold loan business. So certain changes, as soon as a certain policy changes, they tweak something, certain stock will run up. But that doesn't mean that we jump into that micro sector and, get in there. Gold, microfinance are certain spaces. We did have an exposure to gold, a microfinance stock, which was dependent on certain states. Now we are monitoring that and we're trying to exit that stock. I'm being very transparent in that. Whereas the large, well-established companies with, very efficient management, highly able promoters with integrity, names like Chola and Bajaj and HDFC Bank are there. They are good long-term bets which can ride off all of this, and they are nimble enough to get into opportunities that come up. So that is our take on the finance space. Arvind is asking a question: what is your outlook for the next 2 to 3 years on defense stocks? It's bullish. The world is seeing a reset. There are wars happening everywhere. Indian companies have proved their technology. In fact, a few hours ago, some of the ballistic missiles from Iran, they did go and land in Tel Aviv and other parts of Israel. And I was seeing somebody in social media remarking that maybe they should have imported our air defense system. So HAL has a lot of export orders in Egypt, and other our navy is seeing export orders in countries like Vietnam. BrahMos has good market in Vietnam. So we are seeing a very good and I personally feel that this sector will be the North Star for a lot of other manufacturing and electronic components for India. And a lot of talent will get attracted into this over the next few years. So it's a generational change that is happening out there. Next question is, from a mutual fund perspective, can you please explain which sector is good to invest? Like large, middle, small, multi-cap, any specific sectoral fund. Let me take this. In general, while we did speak of sectors earlier, that is to get a flavor of how the economy is doing um, at a more ground level. Of course, the first part of this call was on the macros and geopolitics and global, which is also important. So, so that way, that's how we try to balance both perspectives. Now, from an investing perspective, we feel that for an investor or even a fund manager to bet on a particular sector only from a fund perspective is very risky. Um So our view is that one should go for a diversified fund. Uh, Speaking of mutual funds, if it could be a multi-cap fund or even better, a flexi-cap fund, uh, and not get exposed to the vagaries of trying to time which cap will do, which market cap will do well. Definitely not which sector will do well. Um, so what we have done is now uh, we have built an algorithm for measuring the quality of every fund. And for our clients, we're actually giving that data in terms of which fund is having high quality of stocks. And we measure the stock quality by looking at the roots and wings criteria, which is roots being strength of balance sheet, consistency and return on equity, and promoter integrity, and wings being continuous growth in sales, uh, operating profit and bottom line and market share. So these are a lot of numbers that go in and we arrive at a score for a stock. And based on what stocks a fund is holding, we're able to gather a weighted average score, and that we use to recommend which funds to invest for our clients. And this strategy has definitely done pretty well for the funds that we've picked over the last 6-7 years. And now what we've also done is we have built a strategy called Coral in our PMS, which actually does this. But instead of going for a mutual fund, it actually picks a what's called an exchange traded fund. An ETF is also a basket of stocks that is held by an AMC. And more often, the ETF will mirror an index. So usually Nifty has an index which is scientifically calculated. And what we have done is we have devised an approach where every quarter we collect the numbers for a sector. And those numbers are then uh, crunched. We look at how the sector is performing, and based on the sectoral performance, we then look at which ETF to invest in. So the beauty of this model is that it's well diversified. It is not wedded to a particular sector. And in fact, if I share one slide with you, uh, this is the approach. So it automatically picks the sectors based on certain rules. And the rules at a sector level are defined like this. I mean, I'll not get into the details here. The time is limited. And then based on that, if you see over the years, it has basically added different sectors at different times. And the sectors that it has picked are basically purchased by buying specific ETFs of reputed AMCs. Okay. And this approach, when we have backtested it, it has given phenomenal returns. And the benefit that you get is that you get a structure to sector investing without having to bet on a sector. And there's a combination of technology and machine learning algorithms. And you avoid the risk of high beta stocks. And this actually works even better for NRIs. For NRIs, the issue is that the they have to pay taxes on the accrued gains. Whereas if the NRI, especially a US based NRI, if they invest in stocks or ETFs, they don't have to pay tax every year on the accrued gains. That's a big difference. And even for resident Indians, there are a lot of benefits. So that is our take on sectoral investing per se. I think I've answered Neil's question from all aspects, I believe. Next question is Sanjay Chakravarti. Will the fund selection strategy be primarily local demand driven? Do you see the rare earth metal space growing in 2 to 3 year horizons? How do you see growth in space technology? Manoj?
Okay, three separate questions, and you cross the time, so I'll try and be brief. Fund selection strategy will not be local demand driven. We do not put any such filters. We go by our philosophy and our model, and based on completely neutral criteria. We look for companies which are going to do well. So some of them would be local demand driven, some of them could be export led, some of them might have some other competitiveness. So it is not that one particular thing will drive our selection strategy. Rare metal space growing in 2 to 3 years horizon. Short answer, yes, but then your guess is as good as my guess. But we are looking at the possibility of this space growing. How do you see growth in space technology? Again, as Ram mentioned earlier, a lot of interest is being generated here. The new generation particularly looks excited. So therefore, we should see a lot more work happening, and therefore many growth prospects emerging in this area. Okay. I think the next question was, no, is not a question.
Just, I wanted to add one point on the sectoral theme, the ETF theme that was mentioned earlier. So one way to get into sectors is to buy those sectoral ETFs. But there's another excellent thing. See, the reason why I'm raising this is that passive investing or ETF investing is picking up in India in a big way. So we as investors, we can actually benefit it by investing in baskets of those. So one basket was sector-based ETFs, which I already talked about. Second basket is through, there are a lot of indices like Nifty Alpha 50, Nifty Momentum 50, Nifty 100 low volatility, Nifty. So these give excellent opportunity to invest in different companies which meet certain factors. The factor could be quality, it could be momentum, it could be market cap, it could be various things. It could be volatility and all of that. So the idea here is, so the themes are, like I said, the factors are momentum, quality, volatility, alpha, dividend, equal weight, market cap, etc. And here, if you see the top indices have done really well, some of the indices in terms of returns, in terms of low volatility. And so what one can do as an investor is based on your risk profile, right? If you are an aggressive, moderate, conservative, you can invest in various baskets of these, which are tuned for your expected returns, volatility, etc. Okay. So we have done this certain simulation, and we've arrived at various parameters that we monitor, which will determine which index to invest in. So for example, for momentum, what are the things to look at? For quality, what are the things to look at? For volatility, what are the aspects to look at? For value and dividend, what are the aspects to look at? And so we look at all of these and then build a portfolio which can then take an advantage of entire these ETFs. For example, if you see an illustration, right? Momentum strategies, couple of triggers that we had was moving average, crossovers, and relative strength index. So when Nifty triggered these two numbers, after this, over the next 6 months, Nifty gave a return of about 13%. Whereas if we had invested in these momentum strategies that are available, they gave nearly double the return of what Nifty has given. So this is just one illustration of how one can take advantage of sectors and factors through an ETF strategy. And obviously, the management of risk is a key aspect here. So one is at a portfolio level, how do you design it so that one, it meets your risk profile? There are boundaries and triggers for everything. And second is how do you dynamically track this on an ongoing basis? So this is something, again, I think related to Neil's question, which I thought it will be prudent to share. Manoj, do you see any other questions?
No, I think the just thank you note for you from Sridhar, and thanks Sridhar for the same.
Thank you.
Yeah.
If there's nothing else, we'll wind up. We are anyway available. You can always reach out. I'm available, ram@maximumwealth.com. Manoj is also available on phone. And we should be. Thanks, Sridhar. You're saying you're attending the con call after a long time, and views, and yeah, nice. Appreciate your comment there.